Welcome to another episode of Good Value by Antipodes.
Global equities rose for the quarter despite the uncertainty following the largest bank failure since the 2008 financial crisis. Index performance was saved by mega-cap tech, as the market bets we're on the cusp of the Fed pivot. Notwithstanding this rotation in sector preferences, the Antipodes global portfolios outperformed the index. In this episode of the Good Value podcast, I'm joined by Antipodes CIO Jacob Mitchell. As well as our broader outlook for global equities, we're going to discuss Fed policy. The pivot is coming, but will it come as quickly as the market predicts? And we'll also delve into 3 stocks that represent good opportunities in the current environment and touch on emerging pressure points. Jacob, welcome. It's great to have you back on the podcast.
Thanks, Alison. As always, it's great to be here.
Let's start with Fed policy. As we exited 2022, our view was that the Fed was already running policy too tight, given the pace of interest rate hikes combined with the pace of QT. And the risk was that the Fed would drag the US economy into an even deeper recession. Recent events with the collapse of Silicon Valley Bank could tighten the screws further. Can the Fed still engineer a soft landing?
Yeah, look, it's a good question. I mean, investors shouldn't, underestimate the amount of tightening that's already in the system. I mean, the policy rate in the US was close to zero just a year ago versus 5% today. The pace of increase in the Fed funds rate, is one of the fastest in history. On top of this, money supply in the US is now contracting as a result of, QT. And that's also a fairly negative impulse. As the Fed is shrinking its balance sheet at a much faster rate than the previous attempt at QT, between 2015 and 19. Conditions, were already very tight without any fallout, from the collapse of the Silicon Valley Bank. And look, we're yet to see its impact on credit creation. So our view was that the recent 25 basis point hike would represent the peak in the tightening cycle. Now, it looks like there could be one more, but, we're getting very close to the peak. So then the question is, what next? And, we think, inflation will come down. But the question, I think, that we need to think about in terms of a pivot is what type of pivot do we get? Is it going to be a positive one where the Fed starts to acknowledge what we think is, a policy error, that they've been setting policy, using the rear view mirror, using, what is a lagging indicator, i.e. employment, as their key input to setting rates. Now, we understand why they're doing that, because they're concerned about tightness in the labour market feeding into the service sector inflation. But there's real signs in the leading indicators that the economy is softening relatively quickly and unemployment is set to rise. So, is it going to be one where the Fed really starts to loosen preemptively? Or is it going to be a negative pivot, i.e. the Fed tightens, pauses, but stays too tight for too long, and that economy feeds into unemployment, and we really start to see weakness in profits, and it's not until you're really into the earnings downgrade cycle, and until that earnings downgrade cycle really starts to mature, and then the Fed starts to ease, that you find the bottom in the market. And it's worth adding, even with a pivot, there's no real guarantee that long-term rates will fall given the size of the budget deficit and along with the debt ceiling issues. So the US Treasury needs to fund that deficit at the same time, which means it needs to issue bonds, and at the same time, the Fed's adding to that issuance supply via QT. So we really need to see, to get the soft landing scenario, we need to see a fundamental reversal in Fed policy, and that's we're not seeing that yet. And with high, with yields where they are today, you can make the case that where PEs are, there's no real margin of error. I.e. the equity risk premium is quite low. It's not there's not really a lot of room to move in markets.
Now, you mentioned ramifications of the collapse in Silicon Valley Bank. Fortunately, the bank's demise hasn't destabilised the US banking system. Well, certainly not so far. How could Silicon Valley Bank's failure impact the real economy?
Yeah, look, it really shone the light on capital ratios. Look, capital ratios in the US tend to be somewhat overstated because of the unrealised losses in bond portfolios. Now, there are some banks that are worse than others, but simple numbers to highlight this: the average Tier 1 capital ratio in the US bank on a mark-to-market basis is closer to 8 to 9%, which is quite low in a global context. And these ratios are dynamic. The value of bond holdings are an asset on the balance sheet, and as yields go up, the value of that asset goes down, and vice versa. But the point remains, US banks aren't as well capitalised as they appear to be on paper. So what does it mean? Even if regulation doesn't tighten, it's those regional banks will be quite focused on risk management and liquidity, rather than credit creation. So we're going to see pressure on bank profitability as well as deposits reprice, and there's more competition for customer deposits. A high cost of funding, would be manageable if most lending was at variable rates, like it is in most banking markets. But in the US, almost 60% of lending is at fixed rates, and the duration is generally above 5 years. So that asset liability mismatch is more extreme in the US than in most banking markets. So if we think about the cost of deposits today, they're still quite low. There hasn't been a lot of repricing against where Fed fund rates is at 5% and what you can get on a money market fund in the US, and that's the concern. Deposit rates will have to close for the banks to keep deposits. They'll have to close that gap on money market funds. And as they do that, that puts pressure on net interest margins and banking profitability. And that's really the essence of what's happening here in the US. It's a profit squeeze. It's a net interest margin squeeze that's taking place against a system that isn't surplus capital because of these mark-to-market issues, and also because buybacks have historically been pretty aggressive in the States. So we estimate that a 100 basis point rise in deposit rates, from the current level of around 1.5%, would bring ROEs down by roughly a third. So from over 12% to roughly 8%. So that's a big structural change in the profitability of the US banking system, and we don't think that's sort of factored in. So when bank executives start to see that coming through, we think that will make them quite cautious around lending, and credit conditions will become they're tight, and they'll become tighter.
And regional banks are important to the US economy, aren't they? They account for 40% of total credit in the US system. But an area that we've been watching quite closely is their disproportionate importance to the commercial real estate sector.
Yeah. I mean, that's right. I mean, regional banking in America is quite different to how we think about it. It's very fragmented. It's not the big brand names that are who are lending to the small businesses. It's sort of smaller banks, regional banks, and look, we define a regional bank as a bank that has less than 100 billion in assets. And in regards to commercial real estate, as you mentioned, they're supplying roughly 40% of the total credit to that to total debt funding of commercial real estate, and that's a sector that already has there are areas of stress. You've got areas like office and more economically sensitive parts of commercial real estate that are starting to either never really recovered from COVID or are just starting to see the stress of a slowing economy. And you also have fairly high leverage rates, especially in properties that are owned in private market, in private market vehicles, and a relatively high degree on variable funding, where you've had the big rate shock. And then on top of that, you've got this issue of the regional banks sort of being a lot more cautious, being a key funder of the sector and being a lot more cautious around funding, which will mean they'll be very circumspect about refinancing, and they'll be looking for the owners of commercial real estate to effectively put in more equity, i.e., better collateral, or let's call it, a higher lending rate in order to compensate for the pressure that they're under in their own funding. So look, what's the way out here to the extent this becomes more systemic? It would be clearly it's to cut rates, for the Fed to loosen policy.
Are you surprised that, given the pace of tightening, we haven't seen more stress in credit and equity markets and the broader US economy? Cracks are appearing in pockets like manufacturing and construction, but the US economy remains relatively resilient, held up by services and a household that's been shielded from higher rates due to fixed rate mortgages. And we're also in an era of fiscal activism. The more pressure tightening places on the economy, the greater the likelihood policymakers respond with more fiscal stimulus. So how should investors weigh all of this up?
Look, it's interesting, isn't it? Because if you listen to a lot of the top-down commentary, it's the majority of it seems relatively bearish. I mean, arguably we're all looking at the same leading indicators, and outside of China and the emerging world, they look pretty bleak. And then you have the bottom up analysts' forecasts, and it's surprising that there's still the earnings estimates for the US are flat. So there's a bit of a disconnect between the top down and the bottom up, and companies are probably not yet sort of seeing it in their own, starting to see it in pockets, as you mentioned, and there is some pressure on margins that we've seen in the December results. Margins came down, but top line was pretty good. So at the moment, it's sort of corporates are passing on costs to their customers, and that's one of the problems the Fed has, right? That's why it's staying fairly hawkish, because it knows it probably has to impact profits to loosen employment, to ultimately bring inflation back into the so-called safe zone. So look, how do you resolve that, if you like, that disconnect? It's probably just keeping in mind that policy, or monetary policy, definitely always acts with a lag. So we haven't seen the full effect of the current tightening, and look, we think we start to see that as this year matures, and we go into 2024. You mentioned fiscal activism as sort of a good way to describe the current regime, and the regime we've been in arguably since 2018, with the Trump tax cuts and when we were close to full employment in the US. So that range of outcomes is still very wide. So we think that broader macro backdrop in the US and the West broadly looks a lot like the 30s or the 70s and 80s, where you had a lot more volatility in policy, which drove a lot more volatility in the economic cycle. And guess what? I mean, that really weighed on equity multiples. A combination of arguably more, higher rates, but also probably more importantly, just more volatility drove the clearing multiple on the S&P down on a cyclically adjusted basis in the 70s and 80s, it averaged around 11 times. And that CAPE multiple today is 28 times. So the challenge we see with US equities is starting valuations are quite elevated, and the earnings downgrade cycle hasn't really. It was only just getting started, and we think there's probably 10 to 15% downside, which on earnings, which would take the current year multiple from roughly 19 times to over 20 times, which is it's a decent premium, especially relative to where bond yields are. So that their equity risk premium is quite low, no margin of error. So yeah, look, that's a good summary, I think, of where we think the US is at, and we're watching things relatively closely. We're very aware that it's you don't want to get too caught up in your own echo chamber. You need to be very open to outside views. Certainly, and certainly as data comes in, we'll be very sensitive to data that disproves our base case. And that that's clearly data that would be let's call it dovish, very dovish inflation data, which would allow the Fed to start to preemptively ease, and you end up with the positive pivot scenario.
Okay, so far we've focused on the US. Let's turn to the other major economic blocs. How are Europe and China broadly placed?
In simple terms, to put it in context of our portfolio, we are overweight, both of those regions. But I think it's very important to, in the case of, Europe, where the outlook is getting, I think incrementally positive, but let's face it, they're going through their own tightening policy cycle, and arguably they're a little bit behind the US. But we think you don't have as big an issue in the banking sector in terms of competition for deposits, and you don't have as much fixed rate lending, because in Europe, unlike the US, the mortgages tend to sit in the banking system, and they are, they're much lower, shorter term. They're predominantly variable rate mortgages. So as policy rates go up and as banks lift deposit rates, they can actually reprice their lending and protect margin, and their starting capital positions are stronger, and regulation has been tighter, and as long-suffering bank shareholders in Europe would attest, they've only just started to do buybacks. So that's a good position to be in, and we think they can get through. That will mean that they won't tighten their lending as aggressively as we think it will happen, in the US. But most importantly, the starting multiple is 13 times, not close to 20 times. So big difference in starting valuation. Importantly, what we own in Europe is actually, we do have some positions in European banks, but we've been benefiting from outperformance there, and we have been tapering those positions. The majority of what we own in Europe is actually, the big overweight is very much driven by multinationals. Arguably, our European portfolio is not very European, and I think that's an important thing. It's important to understand that. In China, it's different. In China, we do have what we own in China. There's a lot of obviously exposure to Chinese economy, and we see this real dichotomy in outcomes where you're actually seeing the Chinese economy accelerate and respond to the easing that started over 12 months ago. So it's going in the opposite direction to what we see happening in the West. And once again, the starting multiple is, let's call it 12 times, and that's quite low. I mean, it means you're getting a pretty big margin of safety, and you could say geopolitical concerns are there, but they're also, we would argue, being you're being compensated for that with a very high equity risk premium in Chinese or emerging market exposed equities.
Jacob, that's a great segue into the portfolio. How is the portfolio broadly positioned against the backdrop of the macro that we've been discussing so far?
Look, we have been relatively constructive, if you like, on the opportunity set, in the sense that you still have this very high multiple dispersion in the market. And that's allowed us, I think, to navigate the environment. And we've also, been purposely, if you like, expressing that, our views in more defensive opportunities as we've gone through over the past 12 months, because we've seen this slowdown coming. And our view was that, more, let's call it defensive, attractively valued stocks would start to outperform, let's call it, attractively valued cyclicals. Cyclicals did very well up to a point, and then the baton was passed to more defensive parts of the market. And we really sort of, I think, captured that transition. And what does that mean? It means we added, over the past 12 months, we've added into, healthcare stocks like Sanofi and Merck have done very well. Staples like Diageo and Heineken have become bigger weights in the portfolio. And then in the software part of the market, or some of the platform, what we call the platform part of the market, Meta's been a bit of a, obviously an interesting ride, but we've stayed the course there and benefited from a rebound and, an improvement in execution in the company. And then we've got the SAPs and Oracles, which the market's rediscovering, and they were very cheap for the quality of the companies that they were, and the perfect companies for an economic slowdown, and one which was, being characterized by sticky inflation, because they have, together with Microsoft, they've got this amazing amount of pricing power, customer lock, and that wasn't being reflected in their starting multiples. Look, in terms of cyclicals, we're not saying you have to become completely defensive, or there's clearly going to be in that cyclical area. Though the preference would be to find a company that is becoming maybe less cyclical, or transitioning to a more structural growth profile. And we see that in the the energy transition, onshoring infrastructure exposed companies. These are the companies that will take over, I think, from mega cap tech as tomorrow's secular winners. Stocks like Siemens Energy. TSMC is a tech company, but I think it also fits that description. And look, in the case of China, as I mentioned, we're quite constructive on the on this economic cycle inflecting, and we think it will be led by as China slowly reopens, out-of-home services will recover, and you have companies like Baidu that benefit from that, as well as a group of emerging Chinese multinationals such as Midea.
So on that note, let's move on to the three stocks that we're discussing in this episode, and that's Sanofi, TotalEnergies, and Midea. Let's start with Sanofi. It's been a top holding in the portfolio for some time now. Performance last year was weighed down by litigation issues, but we've had some positive news on that front, haven't we?
That's right. There was over-the-counter drug Zantac, which was, look, Sanofi was only associated with as a result of an acquisition, and it wasn't Sanofi's drug. It was a drug that Sanofi distributed, and that was more than 5 years ago, and there were issues with let's call it the quality of that, in terms of the manufacturing quality of that drug. And Sanofi had already withdrawn the drug from the market in 2019, so it was this was a known issue. In spite of that, 18 billion was wiped off the stock's market cap when the first court hearing approached last year. Now, we felt the market was acting irrationally and assessed the impact would be closer to 1 to 2 billion. and a reasonable profitability that many of the lawsuits would be ultimately dismissed. Now, a ruling in favour of Sanofi at the end of last year has meaningfully de-risked the investment, and it's been a positive catalyst for a rebound in the company, and that the share price has pushed through to its prior highs in the last few months. Sanofi is the largest position in our portfolio because we think that litigation issue is actually relatively minor compared to the cash flows of the company and the probability of any really significant adverse outcome. And it's a company that's fairly insensitive to the economic cycle. It's not facing any material patent cliff in its pharmaceutical business, and it has a lot lower, let's call it drug price risk, in terms of its exposure to in the US to drugs where you could make the case that the pharmaceutical company was gouging. That's not Sanofi. So we think it's relatively immune to drug repricing risk that will will happen in the US. As Congress faces its own budget pressures, this will come. This will be a risk, and we think we're relatively protected from that. And look, the pharma business is growing by increasing penetration of its existing drugs, opportunities in its rare disease business where competition is a lot lower, and we think generally the pipeline is underappreciated by the market. Now, on top of that, we really like the fact that 1/3 of revenue is from non-pharmaceutical businesses, long duration businesses like vaccines, where Sanofi is one of the 3 major players in the flu market, and it also has a leading consumer health business, consumer health as in over the counter products that aren't exposed to patent issues. They're already off patent, and look, it's a business that's growing earnings at high single digit, which when you think about that in the context of only paying a P multiple of 12 times and the defensiveness of those earnings, it seems like a really, for us anyway, what we love in all of our investments, which, a very high margin of safety and multiple ways of winning.
Another stock I wanted to discuss with you today was French-listed oil and gas major TotalEnergies, which is also another large position in the portfolio. And I think this is one of those cyclicals that fits into that category of cyclical with secular growth opportunities. We've been constructive on gas for some time, given the role gas will play in the journey to carbon zero. Now, energy prices have softened on concerns around recession, so it would be great to get your outlook on supply and demand and energy prices. And also, if you could touch on Total's role in energy transition.
Yeah, look, a little bit to unpack there, but it is when you think about TotalEnergies, look, we don't think it's going to become the next Chat GPT secular grower, but it is a company I think that has sort of some interesting aspects to it in terms of structural growth that are underappreciated by the market. Look, for just touching on the oil market to begin with, we've gone through a period of underinvestment in conventional energy, by the oil and the large cap oil and gas producers due to a bunch of issues. You've had ESG pressures for these companies not to invest. They had relatively weak balance sheets as they were recovering from a period of excess spend, and there was shareholders quite rightly were scarred by that experience and were pressuring and continue to pressure these companies for returns, cash returns, shareholder returns rather than capital investment. And oil and gas capex, if you think about majors like Exxon and Shell, the 2 largest conventional producers, it's been below depreciation for some time. Exxon's focused on shareholder returns, and Shell is committed to this balance of shareholder returns and investment in renewables. But let's take the market, demand. History shows that a meaningful recession in the US would take demand down by around 2 million barrels per day. Now, offsetting that is China's consumption of oil has been running about 1.5 million barrels below trend due to lockdown and minimal international flights. So we can see a situation where high demand from China's reopening can somewhat offset contraction from a severe recession. And we think globally, gas will continue to be well bid as an important stepping stone as economies seek to decarbonise. And look, we also have the fact that basically Russian gas is somewhat landlocked. So Europe got through the winter with some good fortune in regards to the weather, but as arguably as a lot of the LNG cargoes that were diverted to Europe, a lot of them came out of Asia, and if Asia and the Northern Hemisphere, as China reopens, we think there'll be less of those cargoes to divert, and also if we have a more normal winter, that will arguably could tighten up the global LNG market, and that's not currently priced in. Look, why Total? We think in summary, we think the market will remain relatively tight and energy prices supported even in a recessionary environment, which is quite different to what we've had in the past. And the big difference being just the lack of investment to grow output. Total, just to bring it back to where we started, it's continued to invest in, and so it will grow output. Its upstream business is fairly evenly split between oil and gas, and investment-wise, about half of its capex is focused on oil, with the other half a balance of gas, renewables, hydrogen, and other transition technologies. So it's out of the majors, you could make the case that it has, the best and most balanced growth portfolio, and the stock is available on a 13% free cash flow to equity at today's oil price. So I think once again, you've got a relatively large margin of safety against multiple ways of winning.
And finally, what about Midea? This is one of the dominant air conditioning manufacturer in China, or certainly one of the dominant air conditioning manufacturers in China, with a growing international business. What opportunities do you see for this company?
Yeah, look, it's a part of let's call it an emerging cluster, Midea, in our portfolio of, as we call them, emerging Chinese multinationals. So we're also constructive on a company called Sanofi, which is very dominant in excavators, and look, it is a reality that China has, given the size of its home market. Its home market today is roughly the same size as the US's home market. So it's going to have companies that have domestic scale, and those companies are now pushing into international markets. And you might think air conditionings are boring, but at the end of the day, there's a real need to drive efficiency in air conditioning because of its a major draw on energy, and in a world where we're trying to where the energy transition and efficiency is the way we use energy is going to continue to be a really important that we continue to drive efficiency. You are getting these dominant companies that have competitive advantage dominate market shares, and Midea is one such company. And look, you get, I think, in the shorter term, you get the benefit of a rebound in the Chinese economy, a rebound in property, and just consumer, let's call it consumer sentiment, consumer spending. You have surplus savings, roughly 14% of current expenditure as a result of lockdowns that will get deployed. And so you have a cyclical recovery opportunity at the same time that this company is really demonstrating that ability to capitalize on export sales. It is also a company that has, it's in addition to its air conditioning business, it has a robotics business, and it's a very well-run private firm, and it's sort of been quite innovative in its go-to-market strategies. Has a effectively a direct-to-consumer type business, And it's a business that we think can sustainably grow at around 10% per annum, and it's available on a multiple of let's call it 12 times this year's earnings, which is pretty attractive for a high return on capital, steady, relatively high growth, steady grower, and hence we see it as quite an interesting investment.
So to wrap that up, we have a big cap pharma, a conventional energy business with a transition angle that's being ignored by the market, and an emerging Chinese multinational that will benefit from a domestic recovery that is also capitalising on international opportunities. 3 very different businesses, very different opportunities that are suited to the current environment. But what about pressure points? Earlier in the podcast, we discussed commercial real estate as an area to watch. Where else do you see risks emerging?
Yeah, that divergence, I think, in policy, you've got, let's call it probably the positive leg of that, as we mentioned earlier. China, it's where you've seen, seeing the benefits of easing. You've got the US, which is at the other extreme, where you've got really, really tight policy. And then the rest of the world is somewhere in between, where central banks in Europe and Australia, for example, haven't matched the Fed 1-for-1 on hikes. And so, look, we think, and we're starting to see, these issues like regional banks. We don't think the regional bank crisis in the US is over, right? As I said, we think you're going to see pressure on, pressure on capital and pressure on profits, and deposits will continue to reprice. And we have the backdrop of the debt ceiling, which will add to the let's call it complexity. And then the question will be, what happens? Do the non-US Western central banks, do they have to catch up, or does the Fed, is the Fed too tight? What gives? And the evidence at the moment is the Fed's too tight. But I think there's we'll meet somewhere in the middle. And we haven't really, we know that's putting pressure on economies where there's lots of variable rate debt. And, in the US, the household is protected, right, because the mortgages are fixed rate. And that's why the pressures are being felt in the banking system. In most of the rest of the Western world, the lift in policy rates is being passed on by the banking system to the household, right? So the pressure is being felt in the household, which is very different to what's happening in the US. We would be concerned about economies where there's a high level of household debt and large exposure to variable rate mortgages. That describes Australia, the UK, Canada, Sweden, and parts of Northern Europe more generally. The households and the household sector in these markets, especially ones that have a lot of leverage, are going to be challenged. And it really, it does, when inflation in Sweden and the UK is still running at 10 to 11%, that's a tricky environment. Even, and Australia is not out of the woods yet. Even if inflation's at 6, it's still 6. So those policymakers in those markets are, they're really faced with that unfortunate or challenging choice between addressing inflation, supporting currencies with higher rates, or supporting the household and property prices and protecting the economy. So, look, we think, the range of outcomes is pretty wide, and probably from a tail risk perspective, the key thing is to look for cheap ways of hedging some of those risks. And, we do see those opportunities. And, we're thinking about, for example, what does it mean in the case of the Australian economy as a microcosm of this pressure on households, and ultimately how that plays out with banking profitability. And given that Australian banks are large in a global context in terms of market cap, and that's primarily, because of the level of household debt in the economy, not so much because of the size of the economy, but just the level of household debt in the economy and the multiples that the banks trade on here. So, I think it's, which are very high, and on a price to tangible book basis, the Australian banks relative to global banks are close to their all-time relative high valuations. So it's probably the other bigger issue is just currencies. As that policy divergence starts to narrow, either because the Fed cuts or the rest of the world catches up with rate hikes, we would imagine the US dollar would ultimately, weaken against other Western currencies.
And the team has been doing some interesting analysis on the Australian banks, so I think watch the space. Jacob, let's leave it there. Thanks for another great quarterly update.
Excellent. Thanks, Alison. A pleasure as always.
If you've enjoyed this episode, don't forget to subscribe to this podcast so you can get an alert when the next episode goes live in a few weeks. For further information on Antipodes, head to our website antipodes.com, and you can also follow us on LinkedIn and Twitter.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.